You've been in the house a few years now. The mortgage payment goes out every month, quiet and automatic, and somewhere in there, a number has been growing. Then something comes up that needs real money, a new roof, a kitchen that's finally falling apart, a hospital bill, and someone mentions it almost in passing. You could just borrow against the house. Then the feeling creeps in, not excitement, overwhelmed, because now there are two products with almost the same name, and you're putting your home on the line to choose between them. Here's the part that changes everything. Both of these are just tools, and they answer the same simple question two different ways. The question is this: how do you want the money, all at once or a little at a time? Once you see it that way, the choice gets a lot quieter. Let's walk through it calmly from the beginning. Start with the thing you're borrowing against. It's called equity, and it's simpler than it sounds. Equity is your home's value minus what you still owe on it. If the house is worth $400,000 and you owe $250,000, the difference is your equity. That's the pool both of these borrow from. Now, the first way to tap it, a home equity loan. This one hands you a lump sum, all of it at once, and it usually comes with a fixed interest rate, one that will not change. You pay it back in steady, predictable monthly payments over a set number of years. It sits behind your first mortgage, which is why people call it a second mortgage. It's a good fit when you know the exact amount you need. One project, one bill, one number. Then the second way, a HELOC, which stands for Home Equity Line of Credit. Instead of a lump sum, you get a credit limit you can draw from as you need it, a bit like a credit card tied to your house. There's a window called the draw period, often around 10 years, when you can borrow, repay, and borrow again. The rate is usually variable, so it can move up or down over time. During the draw, your payments are often small, sometimes just the interest. Then the draw period ends and you enter repayment, where you pay the balance back, and those payments usually get noticeably bigger. And here's why it matters to you more than any rate on any page. Both of these are secured by your home. And that's the quiet part nobody says loudly enough. If you can't pay it back, the lender can foreclose. This is not free money, and it isn't extra income. It's a loan with your house as the promise. A couple more things, both usually carry upfront fees and closing costs. So compare more than just the monthly payment. Lenders also won't let you borrow against every last dollar of your equity. They typically cap your total borrowing at a share of what the home is worth, and that share varies from lender to lender. Whatever they offer, borrow only what you truly need. That limit is a ceiling, not a target. So, equity, your home's value minus what you owe. A home equity loan, a lump sum at a fixed rate, best when you know the number. A HELOC, a flexible line at a usually variable rate, best when you don't. Both are secured by your home. Both have fees. Borrow only what you need. Here's the thing to remember. That growing number in your house is real and it's yours, and tapping it can be a genuinely good decision. But it was never free. It's your home, borrowed against, on a promise to pay it back. Pick the shape that fits what you actually need, keep the amount boring and small, and you turn a scary choice into a plain one. You didn't leap, you walked, one small ordered step at a time.